Welcome back to the Daily Crypto Deep Dive. Today's story isn't about hype or headlines or whatever coin is trending on social media. It's about something far more fundamental, something that's quietly building beneath the surface of the market and could define the next decade of Bitcoin itself. It's the coming liquidity crisis. Not a crash, not a collapse, but a slow, powerful squeeze that could make Bitcoin scarcer, stronger, and more volatile than ever before. Because the truth is, we've never seen this kind of setup before. For the first time in history, Bitcoin has become the most institutionally absorbed, publicly accessible, yet privately hoarded asset on Earth. And that combination is setting the stage for a supply crunch that even seasoned traders don't fully understand. The signs are already here. Exchange reserves at all-time lows, long-term holders sitting on 70% of supply, and ETF demand quietly eating into what's left. But the real story isn't in the numbers. It's in the psychology behind them. Every time a new cycle begins, Bitcoin is supposed to become more liquid, more tradable, more available to the next wave of investors. But this time, it's the opposite. Every upgrade, every institutional product, every regulatory step is actually pulling liquidity out of the open market and locking it away. And if you understand why that's happening, and who benefits from it, you start to see the entire crypto market in a different light. So let's rewind for a moment. In the early days, Bitcoin liquidity was almost infinite, because everyone was a seller. Every miner had coins to dump, every exchange had wallets full of cheap supply, and every early adopter was testing the waters. The price was low, but the market was alive, constantly moving, constantly redistributing. Then came the first big shock. 2017. The first real bull run. The moment Bitcoin went from tech experiment to financial phenomenon. Prices soared, but liquidity shrunk. Exchanges struggled to meet demand. Coinbase crashed. Binance's servers melted down. And every retail trader in the world learned what it meant to fight for fill orders. Still, that was a temporary squeeze, the kind that releases once the hype cools. But the next cycle changed everything. After 2020, liquidity stopped bouncing back. Something permanent began to shift. First, the institutions arrived. Not just trading firms, but custodians, ETFs, and billion-dollar funds. They weren't here to flip coins. They were here to hold. And they needed deep cold storage, regulated custody, and long-term strategies. Suddenly, millions of coins were removed from circulation. Not sold, not lost, but locked away for compliance and reputation. At the same time, long-term holders, or hodlers, doubled down. After surviving multiple bear markets, they'd learned that the only winning strategy was patience. So while traders were panicking, veterans were buying. Today, those veterans, plus institutions, control over 70% of the total Bitcoin supply. That means only about 6 million coins remain in liquid circulation. And when you account for wrapped Bitcoin, exchange reserves, and ETF custody wallets, the number available for daily trading may be closer to 2.5 million. That's it. 2.5 million coins available to satisfy global demand across exchanges, brokers, ETFs, and retail wallets. To put that in perspective, if every millionaire on Earth wanted to own just one Bitcoin, there wouldn't be enough, not even close. That's the quiet math behind the coming liquidity crunch. But it's not just about who's holding, it's about how they're holding. Because as ETFs and corporate treasuries accumulate, they're creating a new type of Bitcoin holder, the paper owner. Someone who doesn't hold keys, doesn't move coins, and doesn't contribute to network liquidity. Each ETF approval might look bullish on the surface, but under the hood, it removes more coins from the open market. Those coins don't circulate. They don't get staked or traded. They sit in regulated cold wallets, moving only when massive institutional settlements occur. And that's why analysts are calling this cycle the institutional bottleneck. The price can move fast, but the underlying supply can't. This makes every future rally more violent, because when new demand surges in, there's simply less Bitcoin available to absorb it. And that brings us to where we are today. A market hovering around $115,000, yet still feeling like it's waiting for something bigger. Exchange volumes are thinner than they've been in years. Liquidity books are shallow. A single whale can move price 5% in minutes, and that's before we even hit the next parabolic phase. So what happens when we do? What happens when mainstream capital, pension funds, sovereign funds, and retirement portfolios decide to allocate even 1% of their holdings into Bitcoin? We get a true liquidity event, the kind that rewrites market physics. Because for the first time, Bitcoin might experience what gold never could: a demand shock without a supply response. Every asset class in history, from real estate to oil to equities, eventually increases production when prices rise. But Bitcoin can't do that. Its supply is fixed, its schedule is automated, and its issuance is mathematically constrained. That means every wave of new money entering the market competes for a shrinking slice of availability. That's how bubbles start. But it's also how revolutions begin. Because eventually, people stop seeing Bitcoin as a trade and start seeing it as the trade. The one bet that never debases, never defaults, and never depends on anyone else keeping a promise. And when that realization hits at scale, the liquidity crisis turns into something much larger. A shift in monetary psychology. We've already seen early signs. In the last 12 months, corporate treasuries in Japan, South Korea, and even parts of Europe have quietly begun experimenting with Bitcoin-based credit lines, using their reserves as collateral instead of selling them. That's the next stage of evolution, Bitcoin becoming the base layer of financial leverage. But that also tightens the noose. Because when Bitcoin becomes collateral, it stops being liquid. It's locked in contracts, tied to loans, or held as proof of reserve. Every step that integrates Bitcoin deeper into the economy reduces the amount actually available to trade. So ironically, the more Bitcoin succeeds, the less of it will exist in open markets. That's the paradox that could break exchanges. They were designed for a world of traders, not a world of holders. If supply keeps vanishing while demand keeps rising, price discovery itself could start to fracture. We could see liquidity premiums between regions, where a Bitcoin on Coinbase costs 2% more than one on Binance, simply because availability differs. We could see localized scarcity in countries where capital controls limit withdrawals. And we could even see a return to over-the-counter networks dominating price formation, just like the early days. Because when the public market can't handle size, the private market takes over. That's not doomsday talk. That's how liquidity works when an asset transitions from speculation to store of value. It happened with gold in the 1970s. It happened with real estate after 2008. And it's happening again now, only faster, digital, and global. But to understand just how close we are to that point, you have to look at one more metric: the exchange reserve ratio. As of this week, centralized exchanges collectively hold less than 1.5 million Bitcoin, the lowest since 2013. That means they've lost over 75% of their coins in less than 5 years. And this isn't just retail withdrawals. It's institutional migration. Funds moving coins into private custody, ETFs vacuuming up supply, and miners increasingly selling directly to OTC desks instead of public markets. The feedback loop is brutal. Lower supply on exchanges means thinner order books. Thinner order books mean higher volatility. Higher volatility drives more demand for derivatives instead of spot. And that derivative demand creates leverage, which then amplifies every move. We've seen this movie before. But this time, the stakes are higher. Because in a world where Bitcoin becomes the foundation of digital value, a liquidity crunch isn't a bug, it's a feature. It's the system rewarding patience and punishing impatience. The question is, how do exchanges, funds, and ordinary investors adapt before it breaks? It won't be dramatic at first. There won't be a single headline saying, "Bitcoin liquidity crisis begins." It'll start quietly. A few major exchanges will delay large withdrawals. Spreads will widen slightly between markets. Analysts will call it normal volatility. But under the surface, you'll start to feel it. Market makers will hesitate to provide depth. Hedge funds will find it harder to borrow Bitcoin for short positions. And retail traders will notice that when they try to buy, the price moves faster than it used to. That's what a liquidity squeeze looks like in slow motion. The same dynamic we've seen in every scarce commodity market is coming to Bitcoin. Only this time, the scarcity is digital, transparent, and irreversible. Because when supply vanishes in the face of infinite demand, volatility isn't a side effect, it's destiny. And that's where psychology takes over. When people realize that Bitcoin isn't just valuable but unavailable, it changes behavior completely. Hoarding becomes rational, selling becomes irrational, and the market stops functioning as a market. It becomes a vault. BlackRock's Bitcoin ETF alone absorbed over 150,000 Bitcoin in its first 6 months, nearly double what miners produced during the same period. Multiply that across multiple funds, corporate treasuries, and sovereign allocations, and you get a structural deficit. More buyers than sellers, permanently. That's the blueprint for a liquidity crisis. And when it hits, it won't break Bitcoin. It'll break everything around it. Derivatives markets will struggle to find collateral. Exchanges will ration withdrawals, custodians will tighten access, and governments, especially those already nervous about capital flight, will double down on regulation. That's the moment when decentralization stops being a slogan and becomes a survival tool. Because the only way to move freely in a system choking on its own scarcity is to control your keys. That brings us to the most important lesson in this entire story. If Bitcoin is becoming the world's hardest money, then the ability to hold it directly becomes the world's purest form of freedom. And that's why, right now, before this shift fully unfolds, securing your crypto isn't optional. It's essential. In a world that's digitizing faster than trust can keep up, the only thing that truly belongs to you is what you hold offline. Ledger gives you that control. It's the most trusted hardware wallet on Earth, built to secure your Bitcoin, Ethereum, and every other major digital asset against hacks, exchange failures, and the kind of systemic stress we've just described. The link is in the description. Now back to the story. Because here's the truth no one on television will admit. Bitcoin doesn't care about liquidity. The market does. Liquidity is a human problem, a symptom of systems that expect infinite supply. Bitcoin was never designed for that. It was designed to expose it. Every time the world demands more dollars, the supply expands. Every time it demands more Bitcoin, the supply resists. That's not a flaw. That's the point. It's the first monetary system that forces discipline instead of promising relief. And that's why this liquidity crisis isn't a threat. It's a mirror. It shows us how addicted modern finance has become to convenience, how dependent we are on instant settlement, leverage, and credit. But Bitcoin isn't convenient, it's consistent. And consistency always wins in the long game. If this sounds philosophical, that's because it is. We're not just watching a price move, we're watching an idea mature. When Satoshi designed the halving schedule, it wasn't a gimmick, it was a countdown. Every 4 years, the world gets reminded that nothing infinite can stay valuable forever. We've reached the part of that countdown where awareness collides with scarcity. Retail knows what Bitcoin is. Institutions know what it represents. Governments know what it threatens. And for the first time, they all want the same thing: exposure. But exposure isn't ownership. And that distinction will define the next decade. Because while ETFs and custodians make Bitcoin easy to buy, they also make it easy to lose touch with what made it revolutionary: self-custody. The people who actually hold Bitcoin, move it, and build with it will shape the next financial order. Everyone else will just rent it. And when you rent money, you obey whoever owns the keys. That's the philosophical core of this liquidity story. It's not just about scarcity of coins, but scarcity of control. When access becomes permissioned, freedom becomes a premium. And that's exactly where we're heading. Because when Bitcoin's price accelerates beyond the reach of the average investor, the real competition begins. Not for coins, but for independence. We'll see it in small things first. People shifting savings into sats, companies hedging cash reserves, even governments experimenting with Bitcoin-backed bonds. But underneath all of it, one silent force will drive everything: scarcity. The same scarcity that broke gold's peg in 1971. The same scarcity that fueled oil's dominance in the 20th century. And the same scarcity that will now define the digital era. So where does this all lead? To a paradox. The more valuable Bitcoin becomes, the harder it gets to use. The more mainstream it gets, the less accessible it feels. And the more people want it, the less the market can provide. That's what happens when a store of value becomes a foundation of belief. Bitcoin will outgrow the infrastructure built to contain it. Exchanges will evolve into custodians. Custodians will evolve into financial utilities. And the original peer-to-peer dream will quietly reassert itself through new layers, Lightning, sidechains, and whatever comes next. The technology will adapt, but the philosophy won't. Because this isn't about innovation anymore. It's about inevitability. Every liquidity crisis in history ends one of two ways, either with inflation or with repricing. This time, it'll be repricing. When the market realizes there's simply not enough Bitcoin to satisfy demand, it won't collapse. It'll reprice upward, violently and permanently. And that repricing won't just change portfolios. It'll change priorities. Banks will start building rails instead of barriers. Governments will pivot from denial to adoption. And ordinary people will finally see Bitcoin not as speculation, but as salvation. That's when this liquidity crisis will stop being a warning and become a wake-up call. Because scarcity isn't the enemy of prosperity. It's the proof of it. The world has spent the last century printing abundance. Now it's remembering what value feels like when it can't be faked. Bitcoin doesn't promise wealth, it promises honesty. And in a system built on promises that constantly break, honesty becomes priceless. So as we head into the next halving, the next cycle, and the next wave of adoption, remember this: liquidity will dry up, volatility will surge, headlines will panic. But behind the noise, something permanent is forming. A monetary order where scarcity is sacred again. And when that order finally arrives, the question won't be how much Bitcoin is worth. It'll be how much the old system ever really was. Drop your thoughts in the comments, follow the show, leave that 5-star rating, and as always, we will see you at the top.